Okay, so this will be video number 4 in the capital market series. Next week, we're going to get into splits. Got a lot of phone calls on stock splits, forward, reverse, etc. And then, of course, on that Thursday, we'll also discuss outstanding shares versus the float. This is all pertaining to phone calls that I received that people weren't 100% clear on. We'll discuss, what is a higher float better? Is it not? What are some of the nuances and benefits of a particular cap structure like that? We're going to get into some of the cap structure stuff today. The following week, we'll discuss S1s, Reg A's. We'll go over the tiers on those. We're going to try to discuss things that are pertinent to what we're going to be doing or what we are doing, and then some things that we are considering. So I want to try to keep this series more relevant to what we do. I know there's some basic definitions and fundamentals that we went over earlier, but this is to help kind of field some of those questions I've been getting in a larger mass. So that's what we have scheduled thus far. Anyone who has something that they would like us to cover, they feel that, from conversations they've had with fellow shareholders or things that they've seen on blogs or chat rooms, etc., if they think there's something that we should address as far as capital markets understanding, then please, by all means, send in a direct message or comment on some of the videos and what you'd like to see. So that's why I go over some of the things we're going to be doing over the next couple of weeks. All right, so let's get started on this fourth video. And, I have a few notes here that I wanted to kind of address, because every time I get a question or emails or some direct messages, I try to jot it down and make sure that I address that in some fashion. So I've gone over quite a bit over the past 18, 24 months of emails and questions. So these seem to be the most common. Okay, so I'm going to start off. We've kind of covered this a little bit, but a publicly traded company is nothing more than shared ownership of a company. We all own the company. I think most people understand that. We all own a piece of a company. And how is that, how does that relate to cap structure and some of the listing requirements? So we're going to go over some of that. So cap structure can be a very complex definition. We're going to super simplify it, okay? I know there are going to be people that understand this. And again, let me just put this disclaimer on there, because we've had a few emails or comments in that this series is not for them. For those that it's not for them, simply don't watch. It's pretty simple, right? This is entry level, some basic fundamentals. Not everyone is at the same understanding level as you might be. Okay, so bear with us. If it's not for you, simply stop watching. Okay, so the cap structure. This is how a company will identify its dollar value, and in doing so, this is how it can fund its operations. Now, I know that, and its growth, subsequent growth. I know that is not the entirety of that definition. So let's take a look at how we arrive at these numbers. It's a combination of equity and debt. It's a combination of the share structure, right? And then, of course, the trading value of the stock. Now, our oversimplification of a cap structure is how many shares you have as far as not authorized, outstanding shares, issued and trading in the market times the price per share at the time. And that's how you can simply arrive at a cap structure. There are other ways to assess cap structure. For example, if you're dealing with investment banks, they take a lot more fundamentals into consideration. So it's not just the outstanding shares. They're going to take a look at the authorized. What can you go to? I think many people understand that, especially with our particular position. And what can the conversion be on any convertible debt instruments, the preferred series shares, and also any promissories. So this is another way or another process into arriving at a certain metric for cap structure. But simply speaking, if you're looking at the OTC markets, then you go on the web page, you'll see cap structures essentially the issued and out times the price per share. Now, why is this important? This is important because the cap structure, as far as the share structure, is set based on the capital needs of the company. So a company goes public for one reason only, really, and that is to raise money. So you have to set your share structure, which contributes to that cap structure that we discussed, in a way that you can raise the appropriate amount of dollars that you need or that are required to fulfill your obligations that are outlined in that business plan when you go public or on IPO. In our case, we did a reverse merger, we had a business plan, and we had to restructure. Okay, so how does that work? So if you have a company trading at $1 per share, we'll just keep it very, very simple, and you have an issued and out or outstanding share count with an authorized count of, let's say, 100 million versus 200 million. So you have 100 million shares out, you have an authorized of 200 million. That is going to give you 100 million shares that you can leverage in some way, whether it's an issuance, whether it's a promissory, whether it's a convertible debt instrument. There's many, many ways to go through this. You have that block that you can use or leverage to raise capital on an as-needed basis. That's why it's really important to look at the authorized. I understand that the issued and out is important. I understand why. But when you're evaluating a company, and we're going to get into this, this is important to understand, especially when we start talking about splits. I get a lot of phone calls. We need to do a reverse split. When can we restructure the company? You know, I've got some people that have been harping on that for quite some time. I think I've made my opinion of that particular strategic action very clear, but we're going to get into it in the next video. So the cap structure is very important in maneuvering and growing and structuring its debt instruments for the company. And so this is important to understand. So as far as that block of shares that are not issued, those are in what we call treasury, right? So they're not being used right now, but they can be in the future. The problem comes, and I know a lot of people are going to ask about dilution. I get a lot of phone calls on this. The problem is when you increase the authorized, right, and you're diluting the value. So it's similar to a currency, because it is money, right? And that's, I think, a lot of people in OTC, especially people running companies, don't understand or appreciate that a stock, every single share is money, right? So if you look at the economy today, you look over the past 13 months or so, and you look at from 2008 on, how we've devalued the dollar, you're going to affect each share the more you issue. So if you take a look at what's happened in the economy, 40% of the dollars created or put into the economy, dollars created, have happened over the past year and a half. Now you're looking at an influx of currency, and that devalues that currency. It's the same thing with shares. So this is important to understand from not only a shareholder point of view, but from an administrator point of view. So when we look at issuances, and we'll go over this in greater detail, especially on the splits video. When you look at issuances, it's important to understand the differential between the issued and out and the authorized, because that potential of issuance can cause dilution, and you devalue the existing share base. That's why when you see a massive issuance, you'll notice that the price may take a dip. It's a supply and demand is more available, and it becomes less value. It's easier to obtain. So that's an oversimplified definition, and I hope people understand that. And if I go too simple, I apologize. I just want to make sure that we could speak to every shareholder, even those that have the most basic understanding or lack thereof, so that way they can get caught up with the rest of us. Okay, so then we take a look at disclosures. So let's take a look at cap structure versus disclosure, because they're interconnected. Disclosures can be a lot of things. So obviously, it's the financial statements of the company, but it also outlines, and for those who have read the disclosures, and I encourage everyone to read our disclosures. We are going to do, I know I promised to do a disclosure video where we get in and we go over one of the financials. We will do a line by line. There's been a little bit of difficulty in aligning my schedule with Tom because we've both been very busy. Obviously, the audits are happening. He's buried in that. We also have Q3 that has to come out, and there's been some other things that we will get to a video because I think it's really important that everybody understands a financial statement. So within that financial statement, there's going to be some disclosure statements, and a lot of those will be pertaining to issuances, and that directly affects the cap structure, right? Now, let's take a look at the OTC markets. On the pink sheets, you have what we refer to as alternative reporting and fully reporting. What does that mean? In simple terms, one company is audited and one is not. Right? So alternative reporting, you're trusting the statement, the disclosure statements of the company. That means that the internal accounting, I want to use an accurate term here, internal accounting is being trusted by those in the market. Now, on a fuller reporting or SEC filer, you are looking at a third-party independent party that is certified PCAOB auditing firm. And all that really means is that there's an SEC standard they have to keep, and they report an audit based off of that standard. So you have fully audited pink sheet company. The other level up would be the QB. Now, typically QB is going to be fully audited, fully reporting. There are some exceptions to that. Obviously, there's some international companies that don't have to adhere to that, but let's just stick with US-based companies because it's more relevant to us. We're US-based. So on the QB, you'd be fully reporting, which means you'd be fully audited by a PCAOB law firm. I'm sorry, accounting firm. And that's what we've retained. For those that are unfamiliar, we retained BF Borgers. We've also brought on Cullen Meadows, which is a law firm, to assist us in the process of getting through the audits, filing an S1, and then uplisting the company. And we're going to get into why would you uplist. I'll do that at a later date. So you can have, it is possible to have an alternative reporting QB, okay, if you're not US-based. There's a minimum requirement as far as price per share. Cap structure does come into play with that as well. And a QB is just not as strict as a QX, which is the next level up. Now, QX, there's a couple of different things with QX. So QX you're going to look at a lot more financial institutions, insurance institutions that are typically on the QX. It doesn't mean it's strictly that. I know there are other companies on that. There's going to be a minimum price per share. They're much more strict on cap structure. Obviously, there's you have to have independent directors on the board. There's a whole litany of higher requirements to be on the QX. It's just a higher reporting standard. So again, those will be fully reported or fully audited by a PCAOB law firm. So how is that different than, let's say, the senior exchanges, the New York, the NASDAQ, and so forth? The New York has, in order to get to the New York, there are 5 listing standards. There's a lot of other requirements, but when you look at the options, there's 3 options and 5 standards. So you have 1 through 4, and then you have 4A and B. So B would be the 5th, and then you have 3 options, and those are all requirements that have to coordinate together in order to meet that. I'm not going to go over those in the video. We can do a New York video because that's something obviously many people I know that we're looking towards, and I will go over that in the future if it's something people really wanted to hear about it, and it may help. I don't know for those that are interested. So these requirements that are being placed on companies in each level. So pink, alternative, full reporting SEC filer, QB, and then QX. And we discussed a few variances on that. It's important to make sure that you take a look at our cap structure. When you look at, we have 1 billion authorized shares. We have close to 1 billion issued and out. I forget the exact number at this particular point, but it's 900 and change. You are looking at an authorized that, or an outstanding, depending on your point of view, that's been maxed out. So the next option for a company would be, let's increase the authorized. That's a terrible idea, especially when you're looking at 1 billion. I know there are other companies that have multi-billion share authorized. We're not going to do that. shares. That's going in the wrong direction as far as I'm concerned, but that is a way for a company to continue, once they run out of shares, to essentially keep printing money, right? And I think we all know that's a terrible idea. So when you look at cap structures on the senior exchanges, you rarely see those high numbers. So in the future, we may take a look at a few things, but for us, I think that the status quo for where we are, these are things that we don't need to change at this particular moment. We will be looking at that in the future. I'm going to go over some other things in the videos. We have a lot of active shareholders that are very interested in the company, and they call, they want to help, they have their input. We've got some professionals that actually work in the industry. I'm obviously a little more guarded when talking to them because I know that they're actively trading and financial advisors and so forth, but that's actually a compliment to, as far as I'm concerned, that they see value in the company. And then today we actually had some questions on institutional investment. We obviously have several companies that have been invested in the company, as well as traditional shareholders. Down the road, we'll look at some institutional investing from VC firms and banking. That is something that we're putting in place. I think I've said that before. These are ongoing discussions. We have to get to certain levels before we can meet certain requirements. And obviously, over the past year or two, it's been a little challenging. Okay, so taking a look at cap structure, issued and out versus authorized versus the price per share. We refer to the active trading, the free trading, as the float, right? So you'll hear that term quite a bit, and people will really focus in on the float. But I think that's a mistake to not take into consideration the issued and out, especially when you're taking a look at the timing on when a legend may be lifted. Legend is the restriction on a certificate. Rule 144 on a non-reporting company is 12 months. On a fully reporting company, audited company is 6 months. So when you look at these issuances, and this is something to take a look at, when you look at these issuances, what's the convertible going to be in, and how's that going to add to the float? Because those are the free trading shares. So the restrictions are based, when you hear of a restriction or a legend on a certificate, that means those shares are owned, but they're not able to be traded in the open market yet. There's a restriction, a limit put on those for a certain period of time. Now, when we get into S1s, this will be something that's important to understand. And why I bring it up now is because the S1, you can register the shares in the S1, and then that legend, once the S1 is approved, would then be removed. All right. So rather than wait the time period. I know this has been a long video. I know I'm going on and on about something that many will think is very, very simple, and you may think this is a waste of time. I had two shareholders call and ask me why I'm wasting my time with this. This is not wasting my time. I can make the time to educate shareholders, and it's a better way for me to manage my time overall, rather than deal with 10, 15, 30 shareholders calling in asking the same question. This is a way for me to address that. So I hope everybody's being patient with that and understanding towards their fellow shareholders that some people may not understand all this. And if you do, you just move on to the next video, or you don't watch any of the videos, to be quite frank, and it won't hurt my feelings. So I don't think I'm wasting my time. So I hope everybody enjoyed this video. Any other questions that you have in reference to this, do not hesitate to send in an email, direct message, or phone into the company. You need to speak with me. I've been very busy lately. I know, I apologize, but I will return the phone call. I know I talked to one shareholder, it took a couple of days, and I apologize to him. He was very understanding. We've been very inundated with getting a few things done. Last week we had the folks in from Precision Engineering and H2O in, so I was tied up in meetings most of the week. We had some pretty high-level discussions going on at the time. Next week I have a whole another round of meetings with some other companies, so bear with me, and I will always return those phone calls. So I'll cut it off now, and I look forward to talking to you next video. Thank you.